Well, good morning, everybody. Let's go around the room. I'm Andy Schaefer, representing Commissioner Kelly.
Barry Dennis, SAS.
Joe Strong, PBA.
Joe Alejandro, PBA. Dan Torelli, PBA.
Chris McGrath, PBA.
Lou Turco, LBA.
Bill McNeely, DEA.
Bob North, Actuary.
Yvonne Nelson, Controller's Office.
Barry Miller, Controller's Office.
Martin Diaz, Controller's Office.
Christina Urani, Controller's Office.
Thad McTee, Controller's Office.
Larry Schloss, Controller's Office.
John Bright, Controller's Office.
Jonas Emery, Office of Finance.
Bob Sensky, State Pension Fund.
Casey Croft, Controller's Office.
Karen Barkley, Controller's Office.
Wesley Felicity, Controller's Office. Clark King, Controller's Office.
Okay. Larry, you want to get us started?
Sure. Everyone have their monthly performance review for March? Good to go in color. I'm going to skip through the economic slides. Pretty much same as. The only headline is probably different than what we talked when we were here last. Was the GDP grew in the first quarter 2.2%. That's too little, and it was below expectations. So muddle is the word of the day, and we are muddling. Let's jump to page 22 for a second, which is the VIX, which is, as we all know, measure volatility of the U.S. equities. And recall, just to set ourselves up a little bit, things got a little crazy in the fall vis-a-vis the euro, and things got very calm again for the first quarter, of which this report is the last month of the quarter. And then in April, again, things kind of got a little scary again in Europe. So my guess is we'll have fits and starts for the remainder of the fiscal year, as well as the calendar year, as well as probably beyond that, all emanating from Europe, without regard to anything that might happen in the Middle East or anywhere else in the globe. If you look on the next page, 23, you see the white line is the current Treasury yield curve. Again, the Fed's just pushing down short-term rates, wanting everyone to take risk. The risk is spilling into the high-yield market where spreads are narrowing, and generally into the equity markets, particularly the U.S. equity market. But that's the plan. So you can see on page 24, again, 10-year rate is a benchmark, generally around 2%. Things were too calm for a little bit, spiked up to about 2.25. There's a little more anxiety now. It's about 191 again. The anxiety in Europe is going to keep going. If you look on page 25, again, you can see the risk premiums coming down on the red line, which is the high yield spread. Similarly, the same thing for the investment grade spread. The good news is on page 27 is that corporate profits remain growing. Again, the bad news is that a lot of that was increased in margins, which was through job cuts. So hopefully that'll get back in balance in the future as the employment situation gets a little better. 28 and 29 really show you that the equities markets are not overvalued. Hence, people buy stocks. And you can see on 30, again, since December, when the ECB flooded the banks with 3-year cheap debt, the equity markets have pretty much rallied. The U.S. is the white line. It's got a little anxious as the quarterly earnings came out in the last couple of weeks. And then again, you've seen a little bit in the most recent 3-4 weeks, anxiety in Europe again, which is the green line, and a flattening in emerging markets, which is red. What that translates into us, actually, jump forward for just 1 second. I probably should reorder these slides, because I jumped you forward all the time for the same reason. But if you look at page... Martin, we should reorder these. Okay. If you look at page 40, the numbers on the left are the markets for the month of March. So again, if you look at the top block is the U.S. equity markets up 2 to 3%. The next block are the emerging and the EFA, sort of down 2 or 3%. Then if you skip a block and get to the bigger block, which is the investment grade bonds, down a little bit, and high yield down a little bit. So, again, not a bad month, generally up. Now if you go back to page 32, it translated into the police pension fund hitting an all-time high. Congratulations. $25.7 billion. And if you look at it on page 33, you can see it's ahead of the end of last fiscal year. So we got 3 more months to keep it going. Because again, the June 30 number is the number that matters. If you roll forward now to page 36, you can see the asset mix. And again, this asset mix is adjusted for A, the new policy weights, and B, for the interim allocations for places where we're below the policy weights and you have to put it someplace. Basically, not very much dramatic. The cash number of 2.8% has come down since then. It's probably below 1% as we speak, or about 1%. We've put about 0.5% into emerging market equities. We rotated about 1% out of EFA into U.S. equities. We funded a new hedge fund manager for about 0.2%. The opportunistic fixed income money is slowly going out for another 0.2%. And we put 0.5% into REITs. So in general, it's equity leaning and a little short on fixed income. You can see that on the next page, 37. Again, just the top 2 boxes. The adjusted policy weight is 65.35, and we're about 68.32, leaning again into equities and out of fixed income, and primarily out of tips. The rest, actually not the rest, page 41 shows you the month of March. We made most of our money in U.S. equities, as you can see there. The month was up about 0.75%. We made a little more than 1% in U.S. equities. We gave back some of that money in emerging markets, and a little bit here and a little bit there. So it brings the total fiscal year to date to about 2.5%. April ended yesterday. I think April was basically flat when all said and done, so let's say we're up 2.5% year to date through April. The rest is all the managers. And let me go to the heads of each asset class, see if I have a comment. Seema?
Yeah.
Do you want to? Yeah.
Okay. I just wanted to highlight on page 43. So we've talked a lot about in U.S. equities, our active versus passive allocation. And you might remember over the last 18 months or so, we reallocated money out of large cap into mid cap and small cap. And through that result, we also ended up increasing our passive allocation versus our active allocation. And right now, police is at about a 75% passive versus 25% active allocation. And I just wanted to highlight some numbers here. So we're starting to have some more meetings with individual managers. Because if you'll notice, I'll just point out the fiscal year-to-date column, which is 5 columns in. I just want to point to the total active domestic equity line. So it's several rows down versus the Russell 3000, which is the benchmark that we use. You can see it's negative 4.35, so 435 basis points behind the benchmark for the fiscal year-to-date. And that's in total active domestic equity. If you scroll down a few more rows, you'll see where the negative numbers are coming from large cap. Still, for us, mid cap's doing a little better, but again, these are gross of fees, so net of fees a bit behind. And then small cap active had a really tough fiscal year. A couple of our managers had a very challenging year. The emerging managers, if you scroll down a little more, also the Russell 3000 managers have had a tougher time. So you see a negative 405 basis points behind the benchmark. If you scroll to the farther to the right, you can see the trailing 1-year column, the trailing 3-year column, trailing 5, and trailing 10. What's noticeable here is the total active domestic equities. If you go back through time, When you go back trailing 10 years, it's flat. And again, this is gross of fees. So we're behind in each of these periods, trailing 5, trailing 3, trailing 1. So we're going to spend some time, a lot of time, in meeting with all of our managers, and we're going to work closely with Barry at SIS to try to think more about perhaps reallocating money at this point once again. And we'll come back to you with a full analysis on that shortly.
Okay. Martin, you got anything on fixed income?
We have a specific manager update that we'll talk about in the executive session.
Okay. Barry, do you have anything?
Nothing.
Yvonne?
No, nothing here.
Okay. Any other questions on March?
So thank you for changing the rebalancing pages for us. Moving them from 1 to 3 is actually a lot easier for me to see. I wonder if you might, just like you do in the performance pages where you show red for under and green for over, if you could maybe take that adjusted policy column and maybe indicate in red where we are outside of our range and need to rebalance. That way it could just focus the board in on where, where we are in terms of our policy and where we need to make a change.
You don't think the picture is good enough on the next on the prior page, which is in
Well, it's hard for
multiple
me.
colors?
Yeah, it's hard to see what the actual numbers are and how they relate down to the page below it.
We'll work on making it as easy to read as possible.
Thank you.
You're welcome. Anything else? Okay. Thank you. So made money in March. Stay tuned here.
I also want to show that we have previously had some issues, just like we have in private equity real estate, getting the IRRs for funds. And the page that I handed out in this book, the numbers will start out for opportunistic fixed income, but going forward, we're going to be showing the numbers. We've worked very hard to get these numbers, literally getting every single cash flow from history. The key thing to look at is since inception number, which is the numbers all the way on the right, which are pretty good numbers. And obviously, we have a lot of new accounts that don't really show up. More to come. More of these stars will be filled in as time goes on.
Okay. So we've talked a lot about risk over the, well, at least since I've been here. And we hired John Bright, who's on my right, who, well, I'll let you explain who you are and your background, and then John's got a presentation on the risk of the portfolio.
Everyone should have this, which is the color version of what's in the back book. Since I notice I've already been nicknamed a professor, my background has preceded me here. I was indeed in academia, a physicist until my mid-30s, and then went to Wall Street.
Yeah, speak up on this.
Oh, you have trouble here.
I don't know if you know, she's the most important person
Yes,
in
yes,
the
she
room.
has already told me about that. Yes,
And that takes a lot for Joe to say.
I'll remember that on payday.
Good press.
So went to Wall Street in my mid-30s, was initially hired as what they call a quant, people who solve mathematical puzzles for them, and had various jobs, ran a trading desk, but most of my time was spent in risk management. And risk management on Wall Street, the risk manager does many things, but two important ones which are relevant to what we're trying to do with the funds are, you know, a Wall Street firm, you have traders all around the world trading their brains out, and it's very important every day to be able to aggregate all the positions. And have we accidentally taken on some huge risk in Singapore we didn't know about? So the risk managers built systems to roll up the risk and aggregate it, both in a naive sense of how much of everything do we have, and also in statistical senses. You've probably heard of value at risk and other measures. And you generate them every day, you look at them every day, because they can change dramatically. The other thing, and probably the more important thing I think that risk managers do, is that virtually everyone employed at an investment bank is thinking of clever ways to make money. And they're thinking mainly about the P&L and how much money we might make for a particular trade. The risk managers are the professional skeptics. We never think about how much money we make, we think about how much money we might lose. So our job is to throw some sand in the gears, slow things up a little, ask lots of questions, and then just in general be professional skeptics. And what I'm trying to do at the city is similar, it's just on a very different scale. And not a scale of size. The total assets under management are comparable to the balance sheet of a good-sized investment bank, but more on the scale of time. Things happen here at a very, very measured pace, so that there isn't a need to look at the positions daily or the risk daily. The value at risk of this fund will be the same tomorrow as it was today, and will probably be the same a month from now and even a quarter from now. Things move gradually. So I imagine I might come back if there were some interesting change in 6 months or even a year. But the positions are what they are. They change slowly. So now I'll turn to the presentation. And I'm not going to tell you all anything, I don't think, that you don't already know. We have a lot of equity risk, and that's intuitively obvious to everyone. And when the dust settles, that's essentially what this presentation is going to say. So my ambition, maybe there'll be an occasional insight, but my ambition more is to present a framework for looking at the risk, so that if things change, if the risks get more interesting, we now have a language in which to discuss the risks. And it's partly a framework for communicating with you all, but also a framework within BAM. If, as I think many of us believe we need to be, if we should become much more nimble in what we're doing and able to change the risk profile at a less somnolent pace. And if, for example, we should employ derivatives, or if we go down the path of looking at factor analysis, and I think you all have heard of things like risk budgeting, which entail massive amounts of leverage. If we change the portfolio in that way, so that we're using leverage or derivatives, then there's going to be not only a need to communicate the risk more frequently to you all, but also to have more robust risk controls within BAM itself. So part of this is to construct a framework for what would be needed in BAM in a more flexible environment. And what I want to highlight are two measures of risk, or two different ways of looking at the risk. The first one is the traditional, what's the volatility of our returns? How much money can we lose statistically, or what we expect to lose over some relatively short period of time? But equally important, and I would argue perhaps even more important for a fund like this, is not losing money, but not making enough money year in, year out over a prolonged period of time. And there's usually a trade-off. You can eliminate the short-term risk, but typically at the expense of taking away yield, so that you fall behind over time. So I want to highlight both the traditional short-term measures of risk, but also make some extrapolations and look long-term, what are roughly the probabilities of falling very far behind. And finally, throughout the presentation, I'd like to highlight the limits of statistics. Statistics can be very appealing. It all sounds very scientific, but we have limited data, and so I'm going to try to highlight as we go on what should be taken with a grain of salt. And then I just mentioned on the next slide what measures we'll look at. First of all, what do we have of various stuff? How much equity do we have, fixed income, etc. And then modify that. Things that are called fixed income, like convertible bonds and high yield, frequently act an awful lot like equity. So then look at the breakdown of assets, not by what things are called, but what they act like. then look at value at risk, the traditional broker-dealer measure of risk, and finally at some stress scenarios, a 10 and 40-year stress, so we can look at the long-term risk of underperformance. So the first pie chart is our asset allocation, and it's a little less than 3/5 in equity, and a little more than a quarter in fixed income, and then bits and pieces in other stuff. If we look by correlation on the next page, so we lump that part of fixed income that behaves an awful lot like equity, namely high yield and convertible bonds, we're up almost to 2/3 equity and 1/5 fixed income. And many of us, and I will later in looking at the long-term exposures, would lump private equity in with public equity. In the long run, you expect it to behave perhaps better, but in synchrony with the public markets. But in the short term, it goes its own separate way. Then just talk a little bit about value at risk. It's a method of using statistics to estimate the likelihood of a loss. And so it's weighting, in essence, what we have in various asset classes with how volatile they are and also how much they correlate with each other. It's a measure that was dramatically oversold in the past and became, the regulators enshrined it as the measure of capital you need. And it's essentially useless for that, as we all saw.
That's what I was going to ask you, if there were problems with value at risk.
Well, not per se. There's more a problem with, whenever you have a shiny new toy, you tend to, love it to pieces and play with it too much. And value at risk has a limited utility, which is why we're even looking at it, but it certainly isn't a measure of the capital you need. And this was, the regulators just got led down the primrose path. It's, on its face, how do you lose $20 billion when the risk measure says $100 million? Yeah. So if we turn to the next page, see that the value at risk, the leftmost bar on here is about 1.2 billion. So what that means is we would expect, it's a monthly value at risk, so we'd expect 1 month every other year the fund is expected to lose about 1.2 billion, maybe a little more, maybe a little less. But it's a measure of how likely losses are.
So that's 5%.
Yeah. And we certainly have had such months in the recent past, so it's not a surprise to anyone. What's interesting here is most of the other things don't contribute at all. You can see they hardly even show up on the bar chart because either they're small or they don't mark to market regularly like private equity, so you don't see the P&L coming through. The one clear signal is in the equity markets, and in fact they're about almost 110% of the risk. So the contribution of equities and equity-like things like junk bonds and converts is more than the total risk that we run. And why it's more is we've been going through repeated flights to quality, where people get all worried about Europe, the equity markets tank, and everybody buys treasury bonds. So our fixed income portfolio, through the rallies, has absorbed some of the losses. And when equities lose money, we tend to gain money there. And one thing I want to draw your attention to is just looking at these statistics that would tell us this is great. We have a hedge. We have fixed income, so whenever equity markets go down, fixed income can rescue us. Rates are essentially already zero. It's hard to see that we can get a whole lot more joy out of having the fixed income part of the portfolio. So the message here is, yes, you look at the statistics to guide your eye, but then you also have to use your judgment and your understanding of where we are in market cycles and not blindly follow what they're telling you.
Can I ask a question
Sure.
about this page?
Yeah.
And then about your comments about our fixed income portfolio. So we had the same fixed income portfolio during the financial crisis,
Yes.
essentially, and it didn't really help us.
Oh, it helped. It helped. Not. You can get an enormous amount of joy out of it, but we certainly
Right.
had a good treasury rally. There was spread widening.
Right.
So if you're concluding in the fixed income portfolio, what I have moved over to equities converts in high yield, they got crushed during the crisis. But
Right.
if you look at treasuries and high-grade corporates, they help.
Okay. So using what we've learned from the past for the future at some point, should we, at a point where rates are higher, should we rethink the fixed income portfolio and the composition of that?
Look, if treasury rates get up to 8%, then we should put all the money in treasuries and go home.
That's our position. However, we're not even close to being there yet.
Yeah,
So,
no,
sorry, Bob.
Yeah, but we're far away.
Right.
The only
But,
way
you know,
in the
planning-
current environment, well, the planning is, I rather doubt we're going to see real rates of return at the levels of the past. The planning would be more, and it's a worthwhile discussion having at some point, if we want to bring up the amount of fixed income, the only way to do that is through leverage. And leverage is scary to many people, and maybe it shouldn't be completely scary, but that's how it's done.
Or you go with longer-term bonds?
No, long-term bonds. I mean, the
So I think
30-year
in the
bond still
future-
has a pathetic yield
Sure.
also.
But I'm saying for future planning, as we're having this discussion, what things can we
Yeah,
think about?
from your
doing in
lips
the
to
future?
God's ears, may we have high yields again, and then this job becomes much easier. Yeah.
Well, I don't want to obviously risk your presentation, but I do want to point out that essentially, and I'm hearing your point, but it ties in with what I was thinking for a while is, should we as a fund be reviewing, for example, the risk inputs, the modeling, anything of that nature on a yearly basis? That's essentially what we don't do now.
The modeling?
Yeah, when we look at our risk, look at our portfolio in general, we stay in a particular position for a long period of time.
Yes.
Sometimes that works for us, sometimes that works against us. The statistics, rule the day. But should we be looking at a more narrower time frame to change the portfolio up?
It's difficult because I don't think you want to turn
Now that
the
we
board
have
into
you on
market
staff.
timers. Yeah, and I'm not a market timer either. I'm a
No, I'm not.
neutral. Yeah.
Essentially, I'm not saying about market timing.
Yeah.
Essentially, I'm saying is, for example, I know other funds look at their portfolio on a yearly basis. They have their investment policy statement. They review it to see if there are certain risks that they need to modify in their modeling, for the next year or whatever, in their forecast. Is that something that would be helpful to us, or should we just leave things right now alone?
No, it's always good, I think, to look at what one might do. Most other funds that I've seen, and certainly our reviewer, is looking at their risks very frequently because of leverage, because of derivatives. We don't do either of those. So I think it's almost impossible without more flexibility in what we do for the risk to be interesting to everyone. I don't mind boring people to death, but my guess is if I came in frequently, that's exactly what would happen, because this stuff changes very slowly. And
That's why I was saying, like, maybe on a once-a-year basis.
Yeah, I think,
yes.
But
That's what I was trying to get at.
Oh, okay.
Yeah, like, I think it's, I hope I'm saying it right, I think it's Lacers, Los Angeles, or maybe even CalPERS, I'm not sure. Well, CalPERS has an investment subcommittee.
Yes.
But I believe they look at their risk modeling, like, on a yearly basis. They look at inputs, they look at things. they may well be involved in other investments that we're, asset classes that we're not involved in, but I believe that's what I'm trying to get at. Do we need to look at this more once a year? Because essentially, we don't really look at our investment policy statement more than every few years.
Yeah. No, once a year, that would seem appropriate to me, unless we started doing much more interesting things, then it would be my job to say,
Right.
I should come back, because the things are dramatically changing.
Well, I believe we are discussing, we're into hedge funds now.
Yes.
I think there may well be a discussion down the road looking at maybe adding a little bit of commodities in there somehow. I'm not sure, maybe through the hedge funds. So that would be a discussion, obviously.
As long as we're adding pieces at the margin, the equity risk will continue to so dominate the portfolio that it'll swamp out that signal. It's only really if we were to dramatically change it that you would get a different risk signal.
I would say, Joe, that the way to do it, given the way we're set up, is to go through the asset allocation with Barry.
Right.
Once a year, start, all right, here's the beginning of a fiscal year, here's the end of a year, here's the beginning, here's our asset allocation, here's where we started at the beginning of the year, here's where we're migrating, because we did make a big change, here's where we are, do we like where we are? Do we like it? Do we want to stay on the path? Change it a little, tweak it, and I'd have Barry update the asset allocation analysis, because we made a lot of changes between, I guess it was last June or so that we redid it, right? And it used to be once every 3 or 4 years we redid it. I think it's better to check the patient once a year,
Right.
which is your risk, which is his asset allocation. It kind of brings it all together.
Right.
That's I would tell you that's a good way to do it.
Okay. I apologize. Thank you.
No. The next slide, this is here, in part to highlight, because we're trying to build a framework within BAM for looking at the risk, all the numbers were prepared in-house, which is burdensome because we don't have a whole lot of staff or computing resources. But you have to do it yourself once just to know what you're looking at and know what assumptions are going in. This is a value at risk report prepared by a vendor that Bank of New York uses. It sits on top of the custodial system. And we may eventually transition to this or something similar because they're in production mode. They can churn out hundreds of reports, whereas we're essentially doing it by hand. And this is just to show you can drill down to the manager level to see if any manager looks out of whack. None of them do, but that's the intent of this report.
But again, we're not a trading firm,
Yes.
so you don't need to do it every day.
No. It's just every now and again it's worthwhile looking to see, did some manager, is he popping up? What's he doing weird and different from all the others? Yes. The next page, do some stress scenarios. These are 10-year stresses to the portfolio. And they're somewhat impressionistic. We take equity markets around the world and have them all move in lockstep. We pretty much leave interest rates alone. But they give an impression of what could go wrong over time if certain bad events were to happen. And one of them is the Japanese had their own property bubble, and after that, the Japanese market went down just like ours, but then it never came back. It's just been stagnant. So one scenario is the world looks like Japan, and we don't bounce back. Another is the U.S. in the 70s when we had stagflation, and then a very good stress scenario is just what's happened to us in the past decade, which was miserable. And if we look at the results on the next page, the lovely blue line at the top of Grow, Grow, Grow is the 8% assumption. The lime green is the U.S. during the stagflation, and we fall short. And then the purple is the U.S. in the aughts, and we end up with roughly half of what we are projected to have. And if we turn it to Japan, it's about 40% of projections, all of which are very, very difficult for us. And then, since it is a long-term fund, on the next page, I've tried to, not just picking bad scenarios from the past, but try to put some probability on how likely it is that we could have a very bad scenario. And to do that, since we are dominated by equities, these are just equity scenarios, and look at the past 4 decades. And what were real rates of return, total return on equities? And the 70s were horrible. It was minus. And the aughts were horrible in real returns. And the 80s and 90s were just great. So if we randomly get one of these decades, and then another one of them, and then another, well, if we get like 3 decades, like the 80s or 90s, in 40 years, we're doing great. If we get 3 decades, like the 70s or the aughts, we fall behind. And just how far behind? Well, if we take the 8% return assumption, over 40 years, $1 goes to 21.70. If we randomly choose the decades, the median is 1860. The 8% is roughly in line with what happened over those 40 years all told. But if we look at the bottom quartiles, that's something that has a 25% probability, and we're unlucky enough to get several of the bad decades, then we only make $5.30. So we have less than a quarter of what we're hoping to have.
I'm glad you put that in your presentation, that if you looked over the 40 years, we've actually met or been very close to that 8% return.
Yes. Yes.
It seems that some people have selective memories in city government. So.
Yeah, no, that is true. But it's important to realize it was made up of 2 dreadful decades and 2 really good ones. And what is the probability of...
But that's the nature of statistics. But
Yeah.
if you look at it overall,
Yes.
we have
Yes.
been very close to that 8%, if not above it.
Yes. Yes.
Thank you.
John, I know right now that you don't have the tools to do a greater analysis or more data. Have you worked with SIS with regard to what tools they might have for us that were used when we did our asset allocation study? We did some scenario testing.
What more data did you have in mind?
Well, I think that the data that you're showing us on page 9, it looks like your fixed income returns are static over time in terms of your modeling. You know, sometimes there are tools that...
Well, you could add them in. It's not going to amount to a hill of beans when we got this much equity. If we had a lot of fixed income, we would model fixed income closely.
John, I'm sorry, and I can't hear you.
Oh, I'm sorry. I'm saying if we had a substantial fixed income exposure, then the scenarios results would depend on what we think fixed income is going to do, and we would include them. But the portfolio is so dominated by equity that to me, the most worthwhile thing is to take equity scenarios, take a neutral view of fixed income, let it come along for the ride. If someone wanted to see the effect of fixed income, it's doable, but it's not going to change the story. You know, one thing I noticed coming out of physics and coming to finance, in physics, partly because we were doing really, really hard problems. Really hard problems, we would tend to simplify them. Let's just get the overall structure of the problem. We built toy models, which didn't reflect every detail, but would get you to the essence of it. And then to the extent anyone was interesting, they could add bells and whistles later. There is a tendency in finance, which I think is misguided, to try to throw everything in from the get-go, which then sometimes obscures what the main signal is. So my tendency, and what I will do for you all, is to build more toy models that I think illustrate the central feature rather than bogging you down in details that I think are irrelevant.
I'm just asking if you worked with SIS on this.
No, I would be delighted to see whatever you all have done. I don't think it's going to profoundly change, given how much equity we have, what we look like over time.
You know, we reached the same conclusion that it would be nice to have a safe, diversifying asset that has a yield attached to it, but at this point in the cycle, not. So we're sort of stuck in this more aggressive investment policy, and that's what we concluded last year. So the same conclusion. I think what And yes, we have other tools where the bond returns are entitled to the inflation return. We have scenario analysis that pinpoints different regimes rather than decades. But I think what John has done that we haven't done and should do is to integrate the asset performance with the liability growth. I think that part of it is very helpful.
Larry likes me to point out that the top quartile goes to $30. Yes! Yes, I put that in. I wasn't going to talk about it, but because it's not my job. My job is to focus on the bad stuff, but he always wants me to mention it, so I will.
It's only fair.
Yes.
Because there's a pot of gold at the end of the rainbow.
Yes. All right, and then just the conclusion.
We cannot, by the way, that top quartile is assuming 4 very good decades.
No, that's probably, the top quartile is 3 good decades, 1 bad. 4 good decades,
Well,
you're on the moon.
right, yeah, okay.
But,
Okay.
yeah.
Which, is that a 1 in 300,000 year chance of that happening?
Okay, well, these naive statistics, what do I have? I've got 4 things, 164 probably.
Ask the professor.
Ask the professor.
All right. So what are the conclusions? We can't eliminate the risk from the portfolio. Or we can, but then we can't actually earn any money with it. So we can't avoid potential losses by hiding in fixed income, which we would all love to do, but cannot. And the heavy dependence we have on equities to provide the growth, to provide the yield, there is a substantial risk that we will dramatically underperform with equities if we are so unlucky as to get bad decades rather than good ones. And I don't have a crystal ball, but it does not seem to me inconceivable that we could have a run of bad decades. So the moral of the story to me is that we all need to be thinking very hard about, are there any other ways to get yield, to get return, without this dependence on equities. And to me, one thing we need to think about is just being more flexible and being more nimble in our investment. It's the most surprising thing to me coming from the private sector was the glacial pace at which things happen. And also, I think we have to think about things like leverage, like using derivatives, which sounds scary on their face, but the reality of being so heavily concentrated in equities is scary to me as well. And that's it.
So in terms of our ability to be more nimble, I'm thinking about, I think it's Alaska Permanent, who has, I think, what they call an external CIO program, where they've taken a certain percentage of their asset allocation and given it to a team of what they call external CIOs, who are more tactical in nature on a global basis, or maybe take a risk parity approach. Is that something that you were thinking about for our funds, to your point about trying to be a bit more nimble?
Risk parity, I mean, all these factor analyses, I mean, it's worth going into them in detail because typically you end up with certain factors that you think determine the risk, and then you try to have parity amongst them. And are they really the factors, or are they a statistical artifact? It certainly needs a lot of my skepticism, I think, if we were to go down that path. But it's a little cart before the horse, because you cannot do risk parity without leverage. And so to me, the first thing would be, is everyone comfortable with leverage? Then are we and BAM comfortable we can control the leverage? And then we can look at risk parity. But to look at risk parity before the inevitable consequences of it have been endorsed, it would be, an academic, and I am an academic, I like academic exercises, but it would be an academic exercise.
Well, risk parity isn't getting to the more nimble approach. The more nimble approach is the external
Yeah, but
CIO.
how do the external CIOs work? Are they all just in equities, or if they're more nimble, they're using leverage? So you've just,
Right.
moved it one step beyond.
Is it something worth examining?
Leverage is very worth examining. How one might deploy it, there are hundreds of different ways, but it's cart before the horse.
No,
I'd like to chime in on this a little bit.
Yeah.
I appreciate the conversation about, nimbleness, and I'm a proponent of it. However, it is a sad state of affairs that we are also guided by law. There's a rubric that guides this fund, and that rubric contains the state legislature through various statutes that control how we make decisions at this board. That's what contains us. It's been brought up to my attention about OMERS, and Alaska being one, but Alaska also went to a defined contribution plan, and now they're reconsidering whether that was a mistake, and they may be going to a defined benefit again. But if we want to look at another fund that was used as a model for us, let's look at OMERS, and as I brought up,
I'm sorry, I don't know what...
OMERS is the Ontario Municipal Employee Retirement System, a fund that was predominantly in fixed income.
Yes.
And again, it was pointed out to, I believe, another professor, I think in Canada, they didn't have the basket clause, and they hired a bunch of professional trustees, and the first thing they did was they went to a different investment policy that allowed them to go from a fixed income portfolio to one that contains now, I believe, up to 30% alternatives.
Yeah.
Something we would be prohibited from doing under the law. It's also been my position, we should have been, and as I put on the record in 2007, we should have been in hedge funds, and there was a big delay over that. I will not get into what I consider were some of the decisions of people on this board and why they decided not to go into hedge funds then. We are in hedge funds now, and that essentially helps modify our risk in some way, because now we're going to hedge it. That's why we're in hedge funds. So I'm not essentially of the position that, outsourcing the decision-making potentially of this board to professionals that also helped create the problem that we're in today when they almost collapsed the market by taking excessive risk. I believe that the board here, as it's essentially constructed, can come up to the right decisions, but there are externalities that control our decision-making process here at this board. So that's, my 2 cents as we're here.
And I'm not saying that it's necessarily professionals being nimble, but it is, I think, up to the board, for instance, whether we would do derivatives and things like that, which we could use within the basket clause, I believe. But they're scary,
But those are all discussions that this board can have, and ultimately we would have to, if we decide to go in a particular route, we would have to go to the state legislature and ask them to consider our general expertise in this area, considering our fund.
But also, even, and I don't want to belabor it, but even within the context of the board making decisions, there would be a need, if we were more nimble and we were using derivatives and other things, for more professional infrastructure within BAM. Just so, I would not be comfortable as a risk manager with the current staff if we had a much more interesting portfolio that we could actually tell you the risks in a timely fashion.
I don't necessarily disagree with that position. I think, I don't believe that considering the size, we're the fifth or sixth largest pension, fifth in the United States, and we certainly do not have anywhere near the resources in some of our sister funds that are just as large or larger. In fact, there are smaller funds that have more resources that are allowed. But that's essentially the nature of government in this city. We don't necessarily put the right amount of resources to work. So, but I appreciate the enlightening presentation. I think it's very good.
I would tell you, Joe, that it's. I'm going to come back to you next month and show you some benchmarking of other funds. That it is a board decision as well as the city government, as well as the state government decision. How you staff, BAM, and how you manage your pension funds. And it's not a one-year decision. It's a 10, 15, 20-year decision that at some point you are supposed to look left and look right and look ahead and say, you know what, we've been doing it like this for X number of years. Maybe we're supposed to change the course a little bit, or begin to change the course, or come around. One man's definition of nimble, I would tell you, is another man's definition of just plain slow. And there's a certain speed that's between nimble and slow that we should be at, that I would tell you we're not at. And that's a great conversation having a board, or multiple boards, to say, all right, look, forget where we are. Here's where other people are. Here's the constellation of competitors, because I think all of the other public pension funds compete in the same thing called the financial markets, as do the investment banks, as do commercial banks. It's a global business. You know, are we positioned to compete in a global market? And if you come to the conclusion we're not, which is my conclusion, personal conclusion, I tell you, what are you going to do about it? We can just sit here and say, all right, we'll just leave it the way it is, or you can sit here and say, well, that's interesting, let's go think about this or think about that, and what does it cost, and how should you position the fund? Because again, you take a guy like Bob North at the end of the table, he comes up with 40-year numbers. So someone's thinking long-term. The liability is a long-term thing. And you should manage the assets accordingly, which is what we sit around and talk about all the time. But there's something in the middle, which is the machine to manage it. And I would tell you, we're going to look under the hood and decide together, or all question, because again, this is a multi-year kind of decision. Is the car right? Plain and simply. Do you have the right machine? And if you want to have a different machine or look at other people's machines, I take your point on Omer's and Janice's point on Alaska. Those are completely different machines, but someone decided they wanted it that way.
Different roads too, by the way.
Different roads, different everything. But you know, every now and then, I don't know if we've questioned the machine that we have. I take your point on hedge funds. It's for some reason took longer than it should have. But you know, I think we should have some good conversations on different machine constructs and how you want to do it, and what does it cost, and what are you trying to do ultimately with the machine.
Essentially, I just want to make sure that we're all clear that I believe there are no sides of the table. I think everybody at this table is always seeking to get the best return for this fund, not only for the beneficiaries of this fund, but also to the people who help fund this fund. And we're all trying to get to the best possible return. So I just think this is a good conversation, but you know, we'll continue it.
Right. Any more questions of John?
Thank you, John. This is great.
It's very good.
Okay. If there's nothing else, that ends the control.
And we'll all expect our grades at the end, by the way. So
it's a take-home exam.
I was just going to ask you. I know, and I'm not sure, and I appreciate the background you have, but I know there's like in financial, they have the CFA. I believe there's also one in risk. I don't know if you have that, or you've been exposed to that somehow.
I have.
Or you're just your experience as a.
I worked as a risk manager.
Right. Okay.
Eventually, it grew and grew.
Right.
When I started out in risk management at Merrill Lynch, there were 7 of us in the entire department. When I came back to Merrill after being in another firm, to run the department, there were 150 people. It became a cottage industry. And like every industry, then there are people who are having seminars and meetings.
I don't know.
I never had much time for that.
Officers or,
I mean, we would have our own informal groups of CROs where we get together for lunch. It was very valuable because, look, the traders, if I said they couldn't do something, they would go, but they're doing it at Chase. So I go have lunch with Leslie. Are you really letting your guys do this? No. So then, but it was more informal. There was also the formal side where there were seminars and everything, but I never much cared for that.
Thank you.
All right. Motion to,
Motion to, we're
Adjourn?
done with the,
Yeah.
okay, so
Public
motion
session.
to adjourn the public session and go into executive.
okay. Second, Louis? Thank you. All righty. Thank you.